It has been anything but a normal year for the Federal Reserve, and take a peek into 2021. It also looks like anything but business as usual for the Fed. Our Fed correspondent, Brian Cheung, is here with more. Brian, so I guess one thing we can pull off the table for next year for the Fed is a rate hike. There won't be any rate hikes.
No, and probably not even just for next year, probably nothing through at least the end of 2023. That's what the Federal Reserve was messaging in the dot plot projections that we got in its December meeting. But let's take a look at what we should expect over the next 12 months from the Federal Reserve. We know that they've done an unprecedented amount of actions over the last year or so. When you think about slashing interest rates to zero, restarting quantitative easing, opening up those many emergency loan facilities they've used to backstop everything from corporate debt to municipal bond markets. But looking ahead, three really major questions that are facing the Fed. First off, those emergency loan facilities. So we saw this battle playing out on Capitol Hill as that fiscal stimulus package was being debated over the weekend. There was some concern that maybe Republicans wanted to hobble the Federal Reserve and future Treasury Secretary Janet Yellen's ability to reopen certain facilities like the Main Street Loan Program, which targets small and medium-sized businesses, in addition to the corporate bond buying program and also the municipal liquidity facility. So those things would definitely be in view, although that bill hasn't been passed. The proposed legislation would not allow a future Treasury Secretary to open those things up. So a question would be, would the Federal Reserve want to try to open up something different if it felt like economic conditions were getting worse? The second question is also just about whether or not a quantitative easing will be in view. The Federal Reserve has a $7 trillion balance sheet, and it's growing faster. The Federal Reserve has committed to buying at least $120 billion per month in total agency mortgage-backed securities, in addition to U.S. Treasuries. So the Federal Reserve has offered forward guidance and saying it could ramp that up. But what type of economic conditions would it need to see to want to ramp that up? That remains an open question. And then the last thing is really just, is reflation around the bend? So obviously, barring any sort of issues with the president signing it, that $900 billion stimulus package down in DC could provide some windfall to price increases if it does indeed allow people to have a little bit more money in their pockets once the vaccination or maybe herd immunity comes around next year. Maybe that would spur more consumption, which would tilt prices a bit higher. Now, the Federal Reserve has cautioned that they're not going to immediately raise rates if, for example, core personal consumption expenditures come in at 2%. But if we do see signs that maybe inflation is tilting a little bit higher in addition to inflation expectations, the Federal Reserve might signal an interest to maybe start at least tapering the quantitative easing program, for example. Those could all be things that could take place in 2021. But again, the big question really is going to be, what are we going to see as the economy develops? Because we're at this inflection point, case counts going up, but the vaccine is on the other side of that tunnel. So a lot to watch for in the next year.
You're going to be busy, Brian Cheung. I just wanted to mention, by the way, we just got a headline that U.S. House Republicans have blocked the Democrats' request to increase the COVID stimulus checks to $2,000. Remember, it's $600 in the bill as it was passed, but then the president threw a wrench in the works and said it should be $2,000. That right now doesn't seem to be going anywhere. Brian, I just wanted to follow up on that lending facility on the part of the Fed and whether it could potentially be renewed. Just refresh our memory. There was some controversy over what the take-up was on that plan, right? That it wasn't that much. And the reasoning sort of was, well, it was as much for confidence building as it was for people actually tapping into it. But how much actually was tapped into?
Yeah, and this is where the conceptual debate kind of falls along, which is, yes, the Federal Reserve, by all standards, its facilities had very, very low participation when you consider that the Federal Reserve and the Treasury were allocated about $454 billion of money to actually back up and stand these programs. Now, the Federal Reserve said that it could lever that money up to $1 trillion in loans into the economy. But what we actually saw was only about $25 billion of usage of that money, which again was allocated to the Treasury to authorize the opening and the backing of those Fed facilities. Take a look, for example, at the Federal Reserve's Main Street lending program. It was this pretty ambitious effort to support up to $600 billion in loans to small and medium-sized businesses. We only saw $10 billion. And keep in mind, these facilities are set to expire in just a week, December 31st. There will be no more Main Street lending programs. That will be loans that will be originated by the Federal Reserve's participating banks. So by all standards, $10 billion of $600 billion is very low. Now, the argument on one side of the coin is that the uptake was so low because the Federal Reserve put that facility in place, which allowed a lot of other lenders in the private space to offer more competitive loans that ended up getting driven to from a consumer demand standpoint to begin with. But then on the other side of things, people arguing that maybe the Federal Reserve wasn't being aggressive enough in the pricing of those loans. That's why no one wanted to take one. So you have an argument about whether or not the Federal Reserve was being too punitive or not being punitive enough in their programs. But that's something that, regardless of either side, the statutory text as part of this stimulus package would effectively close down 3 of those facilities concerning corporate debt, small and medium-sized business lending, in addition to muni bond backstops in the next administration. That's something that the Federal Reserve could not create as the same as they had designed currently. The Federal Reserve could try to do some tweaks and maybe get around the legalese here to do something slightly different, but whether or not the Fed would want to wage that legal battle, personally, I highly doubt it.
All right, get a little rest, Brian Cheung. You're gonna have a busy 2021. Brian Cheung, thanks so much.